Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, August 8th, 2018. It's about a little after 10 o'clock Eastern Time, so the markets have been now trading for about half an hour. So I figured I'd do an update to some of the things that I've been tracking recently. Really a follow-up to yesterday's video. We'll start out here with the futures. This is the NQ, the Nasdaq 100 E-mini 60-minute time frame. So we have now broken down below these rising wedge patterns here. Not impulsive. I have to point that out. We don't have impulsive selling, but we do have a breakdown. Sometimes the selling's impulsive from the get-go, like it was right here. Sometimes you have a little breakdown, a back test. A lot can happen. So bottom line is we're below trend. We'll see what happens there. The trend indicators, we did have a divergent high that confirming that wedge. Trend indicators are pointing lower. So this is the first, at least near-term sell signal. While we will see if this morphs into more, we'll watch and I'll try to gauge this as it starts to pan out. If they just burn through this and take it on up, and I have to say this: the case that these divergences are still in place. I had a great question put to me on the in the trading room today, talking about the divergences on the daily chart. Maybe I'll get to that in a second if we move out to the dailies. But you can see there's still plenty of room here. We're still diverging, so there's room for another kickback rally. And as I've mentioned recently, this trend line, the thing about this trend line, it's not very well defined. And that's also another reason I don't think we're seeing a lot of impulsive selling. This trend line had a lot of reactions. When you have fewer reactions, not as many traders are watching that, so it's not as technically significant. So, uh, point being, this could morph into something else. It could morph into something that looks like this. Right now, I just don't know. So we'll leave the trend lines. Well, I'll leave it like that for now. We'll look at ES real quick. Confirm. I'll get to Bitcoin in a second. Here's ES, same story. This trend line, as I mentioned, was a little bit better defined, and we've also broken down below that. So there it is. We have breakdowns on both ES and NQ. That's the two I like to watch, the big large cap, the two big large cap indices that I like to follow and trade. There's the breakdown, the previous breakdown. So again, we have this rising wedge. We have the negative divergence. If you just focus here, and of course, that divergence also extends all the way back to this reaction high here. So let's see what happens. If we start to get some downside traction, at this point, you could put there's a minor support level there. That's where I'd expect the first reaction, but this is a level I'm more interested in watching. It's 28.33. See if that holds on any back test. Even if we get down there, that's not a good sign in my opinion. Why? Because we broke out. It was a breakout to new highs, back tested it several times, fell back below, regained it again, tested it again. So, the bulls should be able to defend this level on any pullback, and if they don't, then that's not a great sign. And then this is an even more important support zone down here. So those are your levels if you're looking for either downside targets. If we start to get some momentum to the downside, these are sell signals. You could take them on face value. Trendline break. We'll see how well they play out. Again, this is a smaller wedge, much smaller trend line than these previous trend lines. So. But as I said before, I can't rule out the fact, and I'm still very much open to the possibility that this was just, the initial thrust down, a little kickback rally that happened to take out the previous highs, and we could get another leg down here. So let's just see how it plays out. Right now, I'll just say my convictions aren't super strong, but very near term, at least today, I'm looking for a little more downside and possibly more beyond that. We'll see how it develops. There's Bitcoin. Bitcoin has now moved well back below the breakout level around 7,000. That was a key level. Broke down, tried to recover it, and failed. So Bitcoin now is dead to me. This one should have exceeded any reasonable stops back below 7,000. It's just chart looks ugly. We don't have divergences anymore. So, and that would hold true for Riot or any of those proxies. At this point in time, it just doesn't look good now. At best, maybe rally back up here, back test that level. But trading has been just, the charts, it just hasn't been responding to these divergences. And this breakout, bottom line is bigger picture. This was it was a, very tradable trend. We had, a long trade and a short trade, but uh, tried to look at a couple potential longs on the pullbacks and it just didn't pan out. So again, it's a trading vehicle and it may set up. It won't, believe me, won't go off my radar completely. But as of now, there's not anything in the charts. I don't see any well-defined support levels to look at. Um, or any important developments here in the chart. So I'll just drop this one off my radar for a little bit here, and then keep an eye on it. If anything sets up, I'll let you know. And Q we already covered. I should have jumped over to the 60-minute charts of QQQ. Here's that, not a super well-defined trend line, but I had this trend line right here capturing these reaction lows, and there's that breakdown. We can draw it a few different ways. Yeah, we could probably do that. It catches that reaction low, these reaction lows, and actually this, we had a little spike. That's just a candlestick shadow right there, and we caught the body. So this is basically a back test of that trend line. PPO is now rolling over. We have a high-level bearish PPO crossover in effect right now on the Qs. This is a 60-minute chart of QQQ, if I didn't make that clear. We still have that divergent high, and unlike SPY, that was the high. So at this point, we still, you can't argue that this isn't just a kickback rally. Sometimes kickback rallies fall just shy. Sometimes they match the previous high equally. Sometimes they just marginally take it out. So uh, the potential is there for another move down. If we start to get some downside momentum going, again, look for another test of this top of that trading range. That was where we were targeting last time, and possibly a move all the way down, especially if we take out that level. This is still a potential third target zone for this swing trade on the QQQ or any of the NQ derivatives or QQQ derivatives like NQ. And there's SPY. We have that same, this is that minor trend line I was showing you on the 60-minute chart. This chart goes out a little longer in time. And there's the bottom line still, although we made a new high, not an all-time high, but a new multi-month high in SPY, it's still a divergent high right here. So you had negative divergence at this point, you know, little correction, pushed up, made a marginal new high, kept the divergences intact as of now, with the PPO rolling over, confirming those divergences there. And the question that I had put to me, I'll just bring this up in the trading room. It was an excellent question. Somebody asked, Randy, about this, this high back here in January. We had this what appears to be like a blow off top, at least a very powerful market ramp after an extended uptrend. And what that did is it threw these indicators. I remember checking at the time, and don't hold me to this, but if I recall correctly, I went back 20 or 30 years on the S&P 500, looking at the RSI. And if I remember correctly, this was by far the most overbought reading. We've never seen a level of 85 or so wherever this peaked out that time. That was RSI 87. So on the SPY at least here, and same we had similar on the S&P 500, of course, and that was the highest reading over 20, 2 or 3 decades. Now keep in mind that included one of the biggest bubbles we've ever had in the stock market, the dot-com days, leading up to 1999, the top in 2000, and it even exceeded that. So if that's the case, what I'm getting at is it's safe to say this is the most overbought we've been in recent history. So the question put to me was, well, then wouldn't it make sense? We're probably not going to see that level again. So no matter what we do, any high will continue to be a divergent high. And excellent point. So number one, my answer was, don't just use any one indicator. Use several. Use the MACD, the PPO, stochastics. There's CMF, all types of different, money flow indicators, all different types of indicators you can put up there. I have a lot here on the side of my chart. I can pop these up anytime I want. Look at different indicators like on balance volume. You can see some divergence there. We can look at money flows, see the divergences there as well. So we can look at different indicators and confirm those divergences. Now, what we can also do is forget about this high, because that's a good point. We'll probably never see that again. So therefore, any high relative to that will be, anytime soon, a divergent high. So what I had said there too is to, we can discard that and focus on any highs that come after that, any divergences that come going forward, excluding that one. Sorry, guys, trying to draw this out here. So here's a little divergent high working. We have some divergence right there. When I look at QQQ, for example, QQQ that had that huge, overbought reading as well. We had a divergent high there. See, so this divergent high came afterwards. That signaled this big correction, or preceded this big correction, I should say, right there. and that was on that divergent high. Now I've extended this. You have a divergence line here, but if you'll note, take that away and that away, we have now a distinct, completely separate divergent high in QQQ. So this is what I was talking about. Going forward, we can look at other divergences right there. And there's clearly a divergent high. Now this may end up being one or two or three. Right now it's one divergent high. If we happen to take out that previous high, anytime soon it's guaranteed to be second divergent high. And what I mean by guaranteed, if it takes it out anytime soon, because these indicators are lagging so much, there's no way if we popped in sometime this week above the previous high from July, what was that, July 26th, I think, right there, 25th. If we pop above that high right now, this week, that is, if we popped above it, weeks from now, maybe it won't be a divergent high, but right now it will be. So this is what I'm focused on. We still have divergence across the board. Look at different indices, small caps, mid caps, large cap. Take the market as a whole, not any one single index. And then even going back to SPY, and then to just get off the index charts. Despite the fact this was one of the biggest overbought readings in recent or maybe throughout the history of the S&P 500 and a lot of these other indices, it is what it was, and this is how technicals work. There was tremendous momentum leading into that high, and right now the momentum indicators are severely lagging. So in the weekly time frame, I very much include these highs. Think they're significant. The peaks I'm talking in January at those highs, and so you can see we have strong negative divergence. So if the SPY can punch up a little bit more and take out that January high, it will have done so with some pretty significant divergences in place. Okay, let's wrap this up with crude oil. Made mention yesterday again. We had a second shorting up in crude oil. This is a level we've been have two opportunities to short it here. It punched a little bit above that. That was at 69.65. So called about 69.80 is cap both advances. And again, this was covered yesterday. We had a back test, second back test of this trend line. We formed this smaller wedge type pattern. We have a trend line here, which I said would trigger the next sell signal once broken, and that did break down yesterday. And we've had a big drop in crude. There was a breakdown, and we've dropped about over 2% in crude futures. So a pretty nice trade. And I made mention the trading room today. We're at that 67.56 support. This was a line that's been on the chart. You can see a lot of reactions as I go to the left here. And we have the crude inventories coming out as I speak in 11 minutes. They come out at 10:30 Eastern time. So, define your time horizon. I think the case for more downside in the coming weeks plus is starting to shape up in crude. Um, my convictions yet right now I'm still actively trading crude via futures, and I know some of you on the site are using DWT or USO, but right now if you get a quick 2%, which on CL on crude futures, every percent or so is about $1,000 for each contract, so that's a decent move. If you're trading crude futures, and if you're on one of the leverage ETFs, 2% drop, that's, what is it, 4 or 6%, depending if it's a 2-time or 3-time leveraged ETF. So my point being that, inventories are going to come out. One of two things are going to happen. Rarely do you see crude just not react to the inventory numbers. It's either going to pop and reverse off that support. You may get another shorting op if it got up here. I like that 68, 70-ish level if it pops up there, or it can come on straight on down through here, and you can see my next two targets. So you have to define your trading style, whether you want to ride through these type of events like inventory reports on crude oil. And but that's it. There's the charts. And again, the bearish scenario is playing out, and I do favor, despite any pops or rips or dips following the inventory. You can see here we're looking at a series so far of lower highs happening in crude oil, but we also have some higher lows. So right now, the bigger picture is this is a big trading range, and this is again why I don't have this on as a swing trade right now. Now, once this trading range is resolved, if it resolves to the downside, that's going to be pretty darn bearish, and that will most likely open the door for a longer term pullback in crude oil. All right, so let's wrap it up here, and I think I covered everything I wanted to. One thing I'll mention: the other day I talked about sugar shaping up. It's still on my radar. I'm watching the futures and a lot of other things short term. Sugar futures did break out, but it was a very unimpulsive breakout. You can see, look at the volume bars on Kane if you can make them out down below. We had a big volume bar that day, but that took us right to the trend line. We broke out with two low volume bars. And again, this is the ETN. I like to look at the futures. When I see the futures confirm and I see what I want to see, this will probably be an active trade idea. And you might want to take it now, but I shy away from taking breakouts that are not impulsive. So I'm watching Kane. Maybe we get it here on a back test. Maybe it'll start to giddy up here soon. Needs to clear that 715 area, and then you can see first target slash resistance at 738, and then 812, and then 880. Okay, we'll end it here. This has been Randy Finney with Right Side of the Chart. Have a great trading day.